Preparing for accounting at Southern Company interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Southern Company's business, and how does it affect accounting? Southern Company is a regulated electric and gas utility, so accounting must reflect both U.S. generally accepted accounting principles and approved regulatory recovery mechanisms. I would expect significant property, plant, and equipment, fuel and purchased power costs, long-term debt, environmental obligations, and regulatory assets or liabilities. The key is connecting journal entries to rates, cash flows, earnings, and compliance. I would also emphasize accurate close procedures and transparent documentation because utility accounting affects regulators, investors, and customers. While answering, focus on Southern Company's regulated electric and gas operations, capital intensity, rate regulation, environmental obligations, large asset base, debt financing, and the importance of accurate reporting to regulators and investors. Question 2. How does regulatory accounting differ from standard corporate accounting? The business context comes first. Regulators set customer rates, and those rates may not match the timing of costs under ordinary generally accepted accounting principles. When recovery of a qualifying cost through future rates is probable, a utility may record a regulatory asset rather than expense it immediately. A regulatory liability records amounts collected before the related cost or benefit is recognized. I would verify the regulatory order, assess probability, document the accounting judgment, and monitor recovery each reporting period. Make sure to cover the role of regulators, cost recovery, deferred recognition, regulatory assets and liabilities, probable future recovery or refund, and the need to support conclusions with orders, tariffs, and applicable accounting guidance. Question 3. What is rate base, and why is it important to a utility? Rate base is the investment on which a regulated utility is generally permitted to earn an authorized return. It commonly includes prudently incurred plant in service, construction balances, and certain working capital items, reduced by accumulated depreciation and other offsets. Rate base matters because it links capital investment to customer rates and earnings. For Southern Company, disciplined project accounting, asset classification, and depreciation directly influence regulatory recovery, allowed returns, and long-term cash generation. In your answer, discuss rate base components: prudently incurred investment, depreciation, accumulated depreciation, authorized returns, customer rates, and the distinction between accounting earnings and regulatory economics. Question 4. When would Southern Company record a regulatory asset? I would record a regulatory asset when a cost is incurred now but is expected to be recovered from customers through future rates, provided recovery is probable under applicable guidance. Examples can include storm costs, certain environmental expenditures, pension items, or fuel-related differences, depending on regulatory treatment. I would confirm the commission order or established practice, calculate the balance, establish amortization, and reassess recoverability. If recovery becomes unlikely, the asset may require impairment or write-off. Be sure to mention a qualifying cost, probable future recovery, timing differences, regulatory approval or evidence, amortization through rates, and the requirement to reassess collectibility rather than treating every unusual cost as deferred. Question 5. Explain AFUDC and how it is accounted for. AFUDC, or Allowance for Funds Used During Construction, captures financing costs associated with qualifying construction projects before assets enter service. Instead of expensing those costs immediately, the utility capitalizes permitted debt and equity components according to applicable rules. The accumulated amount becomes part of the project cost or is otherwise recovered through rates, then affects depreciation and earnings after completion. I would reconcile AFUDC calculations to construction balances, approved rates, project timing, and capitalization policies. Focus on allowance for funds used during construction, eligible construction period financing costs, capitalization rather than immediate expense, debt and equity components, rate-based treatment, and subsequent depreciation or recovery. Question 6. How would you account for construction work in progress at a regulated utility? Construction work in progress accumulates eligible costs for an asset that is not yet ready for intended use. I would include supported labor, materials, contractor costs, and appropriately allocated overhead, while excluding repairs or abnormal waste. I would verify invoices, purchase orders, project approvals, and AFUDC calculations. Once the asset is placed in service, costs transfer to the proper plant category, depreciation begins, and any regulatory recovery mechanism is updated. Strong project controls are essential because balances can be material. Discuss project cost accumulation, direct and indirect costs, capitalization criteria, AFUDC, transfers to plant in service, depreciation commencement, impairment indicators, and controls over major construction projects. Question 7. How is revenue recognized for a regulated electric or gas utility? Utility revenue is generally recognized as electricity or gas is delivered, based on approved tariffs and customer usage. Because billing dates do not align perfectly with month-end, Southern Company would estimate unbilled revenue for service already provided and reverse or true-up that estimate when invoices are issued. I would test usage data, rates, customer classes, and cutoff. I would separately evaluate alternative revenue mechanisms and credit losses, ensuring reported revenue agrees with operational and billing records. In your answer, cover customer usage, billing cycles, unbilled revenue estimates, tariffs, alternative revenue programs, allowance for doubtful accounts, and reconciliation between operational data and the general ledger. Question 8. How would you analyze fuel and purchased power expense variances? I would decompose the variance into price, volume, generation mix, weather, market purchases, and timing effects. For example, hotter weather may increase demand and purchased power, while commodity prices can raise fuel expense without a comparable volume change. I would reconcile settlements, invoices, accruals, and fuel clause calculations, then determine whether the difference is recoverable through rates or affects current earnings. The analysis should explain both the accounting result and the operational cause. Make sure to cover volume, price, generation mix, weather, market purchases, fuel clauses, timing, accruals, operational drivers, and whether variances are recoverable through customer rates or affect current earnings. Question 9. What impairment considerations are relevant for a utility's long-lived assets? I would begin by identifying impairment indicators, such as adverse regulatory decisions, declining demand, cost overruns, environmental requirements, or a decision to retire an asset early. For assets within the relevant guidance, I would compare carrying value with recoverable amounts using expected cash flows or fair value, depending on the framework. Regulatory recovery can affect the analysis, but it does not eliminate judgment. I would document assumptions, sensitivity, approvals, and any required write-down or disclosure. Discuss triggering events, recoverability, regulatory support, undiscounted cash flows when applicable, fair value, decommissioning plans, changing demand, environmental rules, and clear documentation of significant judgment. Question 10. How would you account for an asset retirement obligation at a utility? An asset retirement obligation arises when Southern Company has a legal or constructive duty to retire an asset or remediate a site. I would estimate the obligation using expected future costs, timing, probability-weighted scenarios, and an appropriate discount rate, then record a liability and corresponding asset when recognition criteria are met. The liability grows through accretion, while the asset is depreciated. I would update assumptions for revised cost estimates, retirement dates, regulations, and decommissioning plans. Be sure to mention legal or constructive obligations, present value measurement, probability, discounting, initial liability, corresponding asset, accretion, revisions, and examples such as plants, nuclear facilities, or environmental remediation. Question 11. What accounting issues arise from pension and other post-retirement benefit plans? Pension accounting requires measuring the projected benefit obligation, plan assets, funded status, and periodic expense using actuarial assumptions. Key drivers include discount rates, compensation growth, mortality, expected asset returns, service cost, and interest cost. I would reconcile contributions and benefit payments, review actuarial reports, and analyze changes in accumulated other comprehensive income. For a regulated utility, some pension-related amounts may receive regulatory treatment, so I would connect generally accepted accounting principles balances to approved recovery and disclosure requirements. Focus on projected benefit obligations, plan assets, service and interest cost, expected return, actuarial gains and losses, funded status, OCI, regulatory deferral, and assumptions such as discount rates and mortality. Question 12. How would you account for debt and financing costs at Southern Company? I would record debt at the appropriate carrying amount, classify maturities correctly, and amortize issuance costs using the effective interest method. At each close, I would reconcile principal, accrued interest, cash payments, new issuances, maturities, and any refinancing activity. I would also review covenant compliance, variable rate exposure, and required fair value disclosures. Financing costs connected with qualifying construction may receive specialized treatment, but the accounting must remain consistent with debt agreements and applicable generally accepted accounting principles. In your answer, discuss issuance costs, effective interest amortization, current versus long-term classification, covenant compliance, refinancing, fair value disclosures, variable rates, and the relationship between financing and capital projects. Question 13. How do capital expenditures affect the three financial statements? A capital expenditure initially creates a cash outflow in investing activities and increases construction work in progress or plant on the balance sheet. It does not immediately reduce operating income unless costs are expensed. Once the asset enters service, depreciation reduces earnings and carrying value, while future maintenance spending may be expensed. Financing can create debt or equity cash flows. I would also consider AFUDC and explain why construction spending, capitalization, and depreciation occur at different times. Discuss cash outflows in investing activities, capitalization on the balance sheet, depreciation expense, operating income, financing sources, AFUDC, and the difference between construction spending and assets placed in service. Question 14. How would you investigate a material monthly variance in operating expenses? I would first quantify the variance and compare it with budget, prior periods, forecast, and operational metrics. Then I would separate price, volume, timing, classification, and one-time effects. I would inspect invoices, purchase orders, payroll reports, accrual support, and cut-off entries, while discussing unusual activity with the business owner. For example, a spike may reflect storm restoration costs rather than recurring maintenance. I would document the root cause, determine any adjustment, and communicate implications clearly. Make sure to cover materiality, trend comparison, budget versus actual, accruals, cut-off, volume and price drivers, account mapping, supporting documentation, management inquiry, and corrective action. Question 15. What controls are important in a utility accounting close? A strong utility close combines detailed reconciliations with controls over estimates and high-volume systems. I would prioritize bank and debt reconciliations, plant subledger to general ledger reconciliations, revenue interfaces, fuel accruals, regulatory accounts, journal entry approvals, and segregation of duties. Reviewers should investigate unusual trends and retain clear evidence. I would also use a close checklist, cut-off procedures, and variance analytics. The objective is not merely closing on time, it is producing complete, supportable, and auditable results. Be sure to mention account reconciliations, review controls, journal entry approval, system interfaces, cutoff, estimates, segregation of duties, regulatory balances, analytics, and evidence sufficient for internal and external audit. Question 16. How do deferred taxes arise in a regulated utility? Deferred taxes arise because book and tax recognition often occur at different times. Accelerated tax depreciation, pension costs, asset retirement obligations, and regulatory deferrals can create deferred tax assets or liabilities. I would identify temporary differences, apply enacted tax rates, assess valuation allowances, and reconcile the tax provision to the return. In a regulated utility, normalization rules and customer rate treatment are especially important because the timing benefit of lower cash taxes may be reflected through regulatory accounts rather than retained entirely in earnings. Discuss book tax differences, accelerated tax depreciation, deferred tax assets and liabilities, valuation allowances, normalization requirements, regulatory assets or liabilities, and the impact on rates and cash taxes. Question 17. How would you account for major storm restoration costs? I would first separate restoration costs that repair existing assets from expenditures that improve or replace assets, because the classification affects expense, plant, and depreciation. I would verify labor, materials, contractor invoices, and emergency accruals, then evaluate insurance recoveries and any regulatory order permitting future customer recovery. If recovery is probable, qualifying costs may be deferred as a regulatory asset. I would also disclose material impacts and ensure the accounting distinguishes storm activity from normal maintenance. In your answer, cover emergency expenditures, repair versus capital classification, insurance recoveries, regulatory approval, probable recovery, accrual completeness, customer rates, and transparent disclosure of unusual events. Question 18. A project is delayed and costs exceed budget. What accounting steps would you take? I would determine why the project is delayed, quantify the overrun, and compare incurred costs with approved scope and budget. I would test whether costs remain eligible for capitalization, or whether abnormal waste, inefficiency, or abandoned work requires expensing. I would update expected in-service dates, AFUDC, commitments, cash forecasts, and depreciation timing. I would evaluate impairment and regulatory recovery, obtain project management evidence, and escalate material judgments before finalizing the close and disclosures. Focus on project status, eligible versus abnormal costs, revised completion estimates, impairment indicators, commitments, AFUDC, regulatory recovery, capitalization policy, management escalation, and required financial statement disclosures. Question 19. Tell me about a time you identified an accounting error or control weakness. In one close, I noticed an accrual was unchanged despite a significant decline in the underlying activity. I compared the balance with invoices and operational reports, confirmed that an outdated estimate had rolled forward, and quantified the adjustment. I raised it with my reviewer, corrected the entry, and documented the rationale. We then added a month-over-month variance threshold and required updated business owner support. That experience reinforced the value of skepticism, timely escalation, and preventive controls. Be sure to mention the situation, how you detected the issue, risk assessment, communication, root cause analysis, correction, control enhancement, and measurable evidence that the problem would not recur. Question 20. Why do you want to work in accounting at Southern Company? I am interested in Southern Company because utility accounting combines technical depth with visible business impact. The company manages major infrastructure investments, regulated recovery, financing, environmental responsibilities, and operational volatility, creating meaningful accounting questions rather than routine bookkeeping. My strengths in reconciliations, analysis, documentation, and cross-functional communication fit that environment. I would bring a control-minded approach while learning how accounting supports reliable service, sound capital allocation, regulatory relationships, and long-term shareholder value. In your answer, connect Southern Company's scale, regulated infrastructure, complex accounting judgments, operational relevance, professional development, integrity, and your own analytical, collaborative, and detail-oriented strengths. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.